Hello everyone, welcome back. I'm Lenny and this week's module will be focused on establishing credit and your credit history. You may watch the video as often as you like. You should watch the videos before our in-class sessions. This will help you to prepare for the class. By participating in this class, you are taking an important first step to building a better financial future for you and your family. Before we begin something new, let's review what we discussed in class: credit cards. Do you remember what credit means? Credit is the ability to borrow money. When you borrow money on credit, you receive a loan, which is often secured by collateral or a guarantee. For example, Marvin makes coffee tables and sells them for extra money. He wants to borrow $1,000 for a new bandsaw and an electric sander. He obtains a loan from the bank and pledges his new equipment as collateral. If Marvin does not or cannot pay back the loan, what will the lender probably do? The lender will take the equipment as collateral for the loan. The bank will first try to get Marvin to pay, but if he cannot or does not, they will probably repossess his equipment and resell it to pay for the loan. Marvin should also be careful to pay his loan back and on time. Late payments will affect his credit history, and lenders may not want to loan him money in the future. Do you remember why credit is important? It's important because it can be used in times of emergency. It's more convenient and safer than carrying large amounts of cash. It also allows you to make large purchases, like a car or a house, and you can pay for it over time. Credit can also affect your ability to obtain a job, buy or rent a house, or to get insurance. When credit card companies, banks, or credit unions review your credit applications, they review the 4 C's to decide whether you are a good risk. Capacity, which was your present and future ability to meet your payments. Your capital, which is the value of your assets and your net worth. Your character, how you have paid your bills or debts in the past. And collateral, property or assets offered to secure the loan. Okay, let's begin today's module on establishing your credit. Establishing good credit makes it possible to receive loans in the future. You can check your credit history by requesting a credit report. A credit report is a record of how you have paid your debts. It tells lenders who you are, how much debt you have, whether you have made payments on time, whether there is negative information about you in public records. We will take a detailed look at a credit report in a minute. First, we will look at the agencies that maintain your credit report. There are 3 major credit reporting agencies: Equifax, Experian, and TransUnion. These agencies receive information from creditors, usually monthly, about whether you are making loan and credit card payments on time. They collect information about bankruptcy filings, court-ordered judgments, tax liens, and other public record information from courthouse records. The reports from each of the credit agencies generally contain the same basic information. First, the report will show your identifying information. This includes your name, your social security number, your current and previous addresses, your telephone number, your birth date, your current and previous employers, your spouse's name if you are married. Next, the report shows details of your credit history. This includes your account record with different lenders. It will show how much credit has been given and how much you have repaid. Remember, how you manage even relatively small bills can greatly impact your credit report. Next, the report gives a list of reviews. These are the creditors and other authorized parties who have requested and received your credit report. Last, it gives a report containing information about you in public records, including collection accounts, bankruptcies, foreclosures, tax liens, civil judgments, delinquent student loan payments, and late child support payments. Collection accounts include bills, like medical or utility, that are referred to a collection agency or attorney, even if you are not sued. Unpaid bills that are not resolved may turn into public records. These include a judgment, which is a court-ordered lien for debt owed to a creditor. A judgment remains on your credit report for 7 years from the date it was filed. For example, if you owe money to a creditor, the creditor may try to recover the debt by garnishing your wages, seizing money from your bank account, or placing a judgment lien against property you own. A tax lien is a claim against property or assets filed by the taxing authority for unpaid taxes. For example, if you do not pay your taxes, the taxing authority can make a claim against your home. A paid tax lien generally stays on your credit report for 7 years, but an unpaid tax lien may stay on your credit report until it is paid. A collection account is a past due account that has been referred to a specialist to collect part or all of the debt, such as if you do not pay your bills after a period of time, the creditor may ask a collection agency to collect the amount you owe. Bankruptcy is a legal proceeding that can release a person from repaying debts. Information in your credit report may determine whether you will get a loan or other form of credit, get a job, be able to rent an apartment. It may also affect the amount of your security deposit. It can also help you to get insurance. Keep in mind, credit reporting agencies do not make credit decisions. Credit reporting agencies simply report the information provided by creditors. This information can affect whether you get your next loan. Creditors may also deny a loan application if you have had credit problems in the past. Credit problems indicate that you may not repay the loan. Lenders may also not want to risk lending you money if there is a negative information about you, including bankruptcies or tax liens in public records. A good credit record indicates that you will most likely repay the loan, and lenders will be more willing to give you a loan. Your credit score is based on the information in your credit report. Your credit score, or FICO score, is a number that helps lenders determine how much of a credit risk you may be. It has become increasingly common for lenders to make decisions largely based on credit scores. It is important to learn how the score is calculated so you can improve your score if necessary to obtain credit. Your payment history is the largest percentage of your credit score. That is why it is important to pay your bills on time. If you do not have a history of late payments, your score may be lowered if your credit card balance is close to the limit or if you have just begun to use credit. Your FICO score is the primary method lenders use to assess how deserving you are of their credit. FICO scores range from about 300 to 850. The FICO model takes into account several factors when evaluating credit worthiness. Your past payment history is 35%. Outstanding debt, 30%. How long you have had credit, 15%. New applications for credit, 10%. Types of credit, 10%. Federal law prohibits personal information like your ethnicity, your religion, your gender, from being reflected in your FICO score. These are just a few of the factors that can affect whether or not you get approved for a loan. While each credit reporting agency may have a different format for its credit report, the type of information they contain is basically the same. It includes personal or consumer information, such as your name, address, and employer, a personal or consumer statement, if you submit a statement to the credit reporting agency to be included in your credit report, an account summary, including creditor information, account status and type, and account history. Inquiries that have been made into your credit history, and public record information, such as tax liens, legal items, bankruptcy, wage items, judgments, etc. Identity theft has become a serious problem. It occurs when thieves steal your personal information, such as your social security number, birth date, or credit card numbers. The thieves might then open a new credit card or bank account using your name, birth date, and social security number. If bad checks are written or bills are not paid, they will show up on your credit report and cause problems for you. What are some steps that you can take to avoid identity theft? Here are a few ways you can minimize your risk of identity theft. Protect your social security number, credit card and debit card numbers, personal identification numbers, PINs, passwords, and other personal information. Protect your incoming and outgoing mail. Your mail carrier may deliver a credit card or bank statement, an envelope containing a check, or other items that can be very valuable to a thief. Or perhaps you will mail a check or papers containing account numbers or other personal financial information. Make sure that you sign up for direct deposit. This prevents someone from stealing a check out of your mailbox and forging your signature to access your money. Make sure that you keep your financial trash clean. Thieves, known as dumpster divers, pick through garbage looking for pieces of paper containing social security numbers, bank account information, and other details that can be used to commit fraud. Before tossing out these items, destroy them. Keep a close watch on your bank account statements and credit card bills. Monitor these statements each month and contact your financial institution immediately if there is a discrepancy in your records or if you notice something suspicious. Avoid identity theft on the internet. Never provide bank account or other personal information in response to an unsolicited email or when visiting a website that does not explain how personal information will be protected. Before our next class, I want you to think about your credit. How many accounts do you have? Do you pay your bills online? Do you know your credit score? See you next week.